Good day fellow traders and value investors, and welcome back to another video. Today we continue our series Start with the A's, and we'll look at Tesla. Tesla is one of those stocks that divides the room instantly. Some people see the future of demonstrating robots, autonomous fleets and limitless upside. Others see a stock that's already priced like everything has gone perfectly. And here's the uncomfortable part. At today's price, Tesla doesn't just need to grow. It needs a lot of things to go right at the same time for a very long time. So in this video, we're going to remove the noise, ignore the headlines, and walk through exactly what Tesla needs to deliver over the next 5 years and what happens if even one part of that story breaks. Let's get into it. Before we talk about the valuation or what has to go right, we need to be clear about what Tesla actually is as a business. Because Tesla isn't a simple company. It's really three different businesses living under one ticker. First, there's automotive. This is where Tesla's most revenue still comes from. This part of business behaves much more like a traditional manufacturer. It's capital intensive, margins move with pricing and costs, and profitability is sensitive to things like demand, incentives, tariffs and factory utilizations. The second business is energy generation and storage revenue, and this one is quietly becoming more important. This includes battery storage products like Megapack and Powerwall, and it's been scaling much faster than many investors expected. And then there is service and other revenue, or service, software and AI optionality. This includes things like service and repairs, supercharging, insurance, used cars, and most importantly software and autonomy features like FSD, or full self-driving. And this side of the business is one big reason why the stock is selling at current multiples. PE of 300, because investors believe autonomy, robotics, AI could become a large, high-margin business later. So when you look at Tesla, you're not just buying cars, you're buying a mix of a cyclical manufacturing business, a fast-scaling energy infrastructure business, and software and AI option. Now here's where things start to get interesting, because when you look at Tesla's numbers on the surface, they don't look too bad. Revenue increased 12% year over year. You can see a couple of things that impacted the revenue. That's low regulatory credit revenue and lower one-time full self-driving revenue recognition. And then in profitability as well, we've seen an increase in operating expenses, mainly driven by sales, general and administrative, AI spend and R&D. And then Warren Buffett likes to look at the increase, or likes to monitor the sales, general and administrative and R&D, because a company that needs to spend a lot of money for their research and development means that they need to, their moat is constantly being attacked, and they need to constantly spend money to maintain that position in the market, maintain that moat. And then increasing share-based compensation, stock-based compensation and restructuring and others, that's a risk for us, because we as investors were getting diluted. And I couldn't find anywhere in Tesla's filings how much buybacks they are doing, so they're not doing any buybacks. So we're not getting dividends, we're not getting buybacks, and we're getting diluted by via share-based compensation. They also mentioned increase in vehicle deliveries and in energy generation. We'll see in a bit how much is that increase. To me it looks pretty much flat. Obviously the energy generation was way higher, but in terms of vehicle deliveries it's not a massive increase. And now to have a look at the production of their cars. Model 3 and Model Y is the key driver for their car revenue, increase in the total deliveries and slight decrease of negative 2% of their production of Model 3 and Model Y. Other models, they built about 11,000 cars in Q3 2025. The deliveries was about 15, and that was other models, there was decrease of 30%. Overall, total production was down 5%, and total deliveries was up 7%. When it comes to storage and delivery to energy, the energy side, they've delivered from 6.9 gigawatts hour in Q3 2024. Their deliveries increased to 12.5 gigawatts hour in Q3 2025, and that's 81% increase. And just before turning to trading views numbers, we'll just confirm that Tesla's model total car production was at 1.6 million, so deliveries 1.636, and then total production 1.65. And then again, Model Y was the key driver for 2025, and then a slight increase in Q4 2025. That's the numbers. They are earnings will be on 28th of January, so after I'll publish this video. And then in our traditional manner, we'll look at the financials in trading view. First, we'll look at revenue. You can see that it's been negative some of the quarters, and then it's been up the other quarters, negative some quarters and up the other quarters. Trailing 12 month, according to trading view, is 95 billion, but for Q3 2025 that was 28.9 billion, 0.09. We can see a similar picture in the net income. We can see down quarters and then double digit up some quarters and then down again some other quarters, and then trailing 12 months at 5.27 billion. And one reason for that is the steady increase of operating expenses. You can see it's been increasing from 2.5 till 3 billion, and then trailing 12 months is at negative 11 billion. We'll switch to annual, and annually, to be honest, it looks like a bit of a different picture. Total revenue has been steadily increasing and double digit growth year over year, increasing from 21 billion in 2018 to a 97 billion in 2024 and is currently sitting at 95.63 billion. And also, if we expand the selling, general and administrative, we can see how numbers have been increasing here as well, from 4.29 billion total till 11.4 billion trailing 12 months. And we can see a steady increase in research and development, as we said earlier. When Warren Buffett is seeing R&D increases and selling and general and administrative costs increasing, it means that the company needs to spend a lot of money to keep its competitive advantage. And then finally, net income. You can see negative net income in 2018, but even so an increase of 50%. And then we can see the net income being up and down, finally positive in 2020, and then it's been steadily increasing to a trailing 12 month of 5.27 billion. And then there's been a few years when it's been high net income of 12-15 billion, but it's been decreasing over the last couple of years. And that's a risk for us as investors when you analyze Tesla. Over to the balance sheet, we'll continue looking at the annual numbers. We've seen that total assets of Tesla have been increasing from 29 billion in 2018 to 122 billion, and that's a healthy increase. As you can see, their total debt is negative, and that's because they have more assets than liabilities. And we can also see that total debt is fairly manageable. It's not been increasing massively from 13 billion in 2018 till about 13 billion in 2024 as well. So that's pretty positive to see. Over to statistics, and we'll switch to annual straight away. And we can see that Tesla is selling for a whopping 293 PE. So investors are happy to pay $293 for $1 of Tesla's revenue. That's pretty high for my liking, but there you have it. You can see gross margin sitting at about 18%. It's not been increasing massively. It's been pretty much steady. On average, it looks like about 18-19%, which is okay for a car manufacturer, but unfortunately Tesla is not priced as a car manufacturer. It's priced like a software company. And then net margin, we've seen that they managed to increase it from a negative net margin in 18-19 to a positive but still fairly low net margin compared to other software manufacturer. And then in the usual manner, we'll look at the current ratio, which currently sits at 2.01, means that Tesla has $2 of current assets for every $1 of current liability. They will have no problems paying their suppliers. And pretty healthy debt to equity. We've seen just about now that total debt was negative, but debt to equity ratio is at 0.17. I like to see it below 0.5. So as we can see, Tesla's numbers are not too bad, but are they justified for their current valuation? I'm not too sure. Now let's have a look at Tesla's intrinsic value now. Let's now have a look at the intrinsic value, and we'll look first at the intrinsic value using the three calculators: Warren Buffett, Phil Town and Peter Lynch's calculators. Warren Buffett's calculator is using the historical book value per share growth. For Tesla, it's been growing from 0.67 of 10 years ago to $24 now. So according to Warren Buffett's calculator, Tesla's intrinsic value should be $584 per share, way above what is currently selling for $437 at the time of the recording. Using Phil Town's calculator, which looks at the EPS growth for the next 10 years, I used 20% EPS growth. That's what was the consensus for the next short term, about 20% EPS growth for the next 3 to 5 years. We'll just keep it for the full 10 years, and then we can see that using these numbers, according to Phil Town's calculators, Tesla should be valued at $335 per share. And then Peter Lynch's calculator is using the PE growth. there is very little growth from PE of 300 till something that will make it a value. So using the three calculators, we get a fair value range between $335 per share and $584. Current price sits right between these. Now let's look at the three case scenarios for Tesla using the PE multiple growth and the EPS growth. And I use these multiples because a PE multiple of 30 is well above legacy autos of 5 to 10x, but it still assumes Tesla keeps its brand premium. PE of 60 implies Tesla is a premium growth industrial, but is justified only if EPS growth of 15% actually materializes. And then the PE multiple of 100 assumes that Tesla is no longer valued as an automaker and is actually lower than today's PE of 300. So in a bear case scenario with EPS growing at 3%, auto pricing pressure persists and energy growth is not enough to offset weak automotive profitability, we could see EPS growing to $174 in 5 years and the Tesla stock could be dropping to $52 per share. Quite a drop from current prices. In a base case scenario with EPS growing at 15%, automotive margin stabilize, energy scales profitably, and Tesla maintains a premium valuation without a full autonomy re-rating, we could see EPS growing to $302 in 5 years and the stock could be selling for $181 per share. Still a drop. And then in a bull case scenario, with EPS growing at 30%, operating margin improving thanks to energy and software, and Tesla is valued as a platform rather than a traditional automaker, we could see EPS of $557 in 5 years and the stock could be selling for $556.94 in 5 years. And we can see that only in a bull case scenario we could see price increase. Putting this all through a probability weighted table, we can see that we get a negative 88% return over 5 years in a bear case scenario, a negative 59% in a base case scenario over 5 years, and only in a bull case scenario get a positive 27% return. That will make a total return over 5 years of negative 45%, which will make it a negative 11.11% compounded annually. We're going to connect these scenarios to the chart and see what technical confirmation says right now. But before we look at the chart, we need to talk about the risks. The first risk is core execution risks. The EV markets can get promotional quickly and price cuts hit margin fast. Tesla specifically flags tariffs as a cost headwind. These aren't things management can control and they flow straight into per vehicle costs. So the core business isn't nobody buys Teslas, it's that profitability is fragile when condition shifts. Then there is technology and regulatory risks. Tesla is very clear in its filings that autopilot and FSD, full self-driving, even in their supervised form, are subject to patchwork and fast-changing regulation. Different countries, different rules, different approval. Even if the technology works, regulators decide when, where, and how it can be used. And that matters because a lot of Tesla's long-term valuations assume faster rollout, broader functionality, and meaningful monetization. Regulation can delay all of that. And there's operational risks that come with the scale. Tesla highlights risks around recalls and field actions, not just the cost, but the service burden and potential brand damage. There's also cybersecurity and product perception risks, labor and workforce disruption including employees, suppliers, logistics, and manufacturing partners. And finally, accounting estimate risks. So now, with the risks on the table, let's see what the chart is actually telling us. Now let's bring this back to the chart, because fundamentals tell you what should happen, technicals tell you what is happening. And right now, Tesla is in an uptrend. Price is above long-term averages, we can say it's moving away from EMA 21. I'll zoom out a little bit just to discuss the levels. We can see there was a little bit of congestion about $150 per share area, but it finally broke through it. It rallied till about 300, where it found resistance, it dropped back, and then it pierced through without any problem through $150 per share, and it rallied all the way till about $300 per share zone. At the $300 per share zone, it found resistance and then it went on a downtrend for a couple of years. Lower highs, lower lows, lower highs, lower lows, lower highs, until it finally found its bottom at about $100 per share. It made $150 per share as a strong support and resistance area. We've seen the congestion in the past and then it pierced through it. It moved with a little bit of momentum, but it came back and retested this area again, and then it was an explosive move within 1 year that's made it move from $150 per share all the way till about almost $500 per share. Clean the face a little bit more, and then we can see that in the more recent time the $250 per share became a strong support zone. It turned resistance in the past into support. It came, it tested it, it bounced off of it, and then we can see that about that area, that's where the long 1 long 2 long 3 have been printed at the end of 2024. Also, just to give a perspective of the bull bear base case scenario, we can see that $52 per share that was in the bear case scenario is pretty unlikely. It didn't happen for a long time. Base case scenario is pretty possible. It's visited a few times. We can see it was about $182 per share. We see it visited the $100 per share, $180 per share on a couple of occasions in the last 3 years. 2023 once, 2024 second time, and then almost made it in 2025 in here when it found this bottom. And then obviously the $550 per share, I believe, that's the bull case scenario. It's pretty possible considering that Tesla has been moving these explosive moves, explosive move, and then this whole explosive move. It's very possible that it will go sideways a little bit, and then within a short period of time it will pierce through that resistance at 500 and make it all the way to the bull case scenario. So there you have it. The chart confirms this trend, but fundamentals say strength is already priced in, leaving little room for error. There's very little margin of safety as well. So let's bring this home. Tesla is not a bad company, and this video was never about proving that it is. It's about something far more important. Whether the stock at today's prices gives you enough margin of safety to be wrong. When we strip away the noise, ignore the headlines, and just let the numbers speak, a very clear picture emerges. Tesla is priced for a strong future, not an average one. The intrinsic value scenario shows us that in a bear case scenario, the stock is very expensive. In a base case scenario, solid execution still struggles to justify the current stock price. And only in a bull case scenario does the valuation start to make sense. At the same time, the chart tells us something important. Tesla is technically strong, the trend is intact, and momentum hasn't broken. So if you're already invested, this is about risk management, not fear. If you're on the sideline, this is about patience, not missing out. And there's a promise I made at the start of this video, not to tell you what to buy, but to show you what has to go right so you can decide for yourself whether the risk is worth it. If you enjoyed this analysis and found it useful, hit the like button, consider subscribing, and let me know in the comments below what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.